Hello again, ladies and gentlemen, and welcome back to the Digital Banking Symposium. This session is all about frictionless payments and digital KYC experience presented by Acuity. In the race for digital banking, our speakers will be discussing ways in which companies can reduce operational bottlenecks around customer onboarding and failed payments and enhance UX, while being compliant with the myriad of regulatory obligations. Today we are joined by Payal Patel, Managing Director, APAC Fintrail, Grace Chong, of Counsel, Singapore and Hong Kong, Simmons & Simmons, Aditi Sholapurkar, Head of Strategy and Corporate Development, NEOM, Irina Chakina, Marketing Director, Asia Pacific, Rapid, and the session will be moderated by Alina Butchur, Director Marketing, Acuity. I will now hand my time over to our speakers for their presentation.
Hello everyone, and welcome to our session around frictionless payment and digital KYC. I am your host for today, Acuity Marketing Director Alina Butchur. A brief introduction about Acuity, the leading global provider of financial crime screening, payments and Know Your Customer solution, has actually marked the 175th anniversary this year. One of the most authoritative and comprehensive sources of financial intelligence that inform decisions of virtually every bank around the world. We're running our business in Asia from our office in Singapore, and we serve customers in 32 countries. At Acuity, we are fortunate enough to be partnering very closely with innovative fintech companies as they build things around the world. On the payment side, we ensure money is moved as fast and efficiently as possible whilst instantly meeting KYC and AML requirements. We help reduce friction in onboarding and payments processes to improve the user experience. And talking about reducing friction in onboarding and improving user experience, on today's panel and for the next 45 minutes, I'm talking to 4 experts in the fintech world. I have the pleasure of being joined by Grace Chong of Counsel Singapore and Hong Kong from Simmons & Simmons, Aditi Sholapurkar, Head of Strategy and Corporate Development from NEOM, Payal Patel, Managing Director of APAC from Fintrail, and Irina Chakina, Marketing Director Asia Pac from Rapid. Hello everyone and welcome to our panel discussion. A social media platform was famous for its core value and move fast and break things. What that meant for startups then and now is breaking the conventional way of thinking about technology. It was about innovating fast, ensuring they were enabling consumers to fix things quicker. And as per CEO saying, unless you're breaking stuff, you're not moving fast enough. In this panel discussion today, we will explore the new generation of startups. Fintech is certainly moving fast, but is it going to go the same road of all startups and start breaking things? Even more responsibility is placed in the hands of fintech companies. We trust them with our wages, our pensions, our supplier relationship, and an increasing amount of our personal data. But at the same time, we're placing an increasing amount of responsibility on consumers. The last generation of startups failed to ever trust customers to take stewardship of their own data. Fintech is getting this right from the offset. With open banking, we're treating consumers as responsible adults and enabling them to share and exchange their personal data. So with these increased stakes, Fintech has to move fast and build things very quickly. Globally, many banks are making progress towards becoming true digital businesses. However, some may encounter challenges in delivering success, and bank CIOs must fully embrace the opportunities to totally transform both their business ecosystems and the underlying business model. The increasingly digital demand in our days are definitely forcing banks to keep up or lose out. In the race for digital banking, we will be discussing ways in which companies can reduce operational bottlenecks around customer onboarding and failed payments and enhance that UX journey while being compliant with the myriad of regulatory obligations. And with that introduction into our panel, I'll dive into our very first question, which is addressed to everyone. Digital banks, because we were talking about digital banks. Hype or necessity? What is the use case for digital banks? Aditi, if you'd like to provide your opinion on this one first.
Thank you so much, Alina, and absolute pleasure to be here. Um, that's interesting, right? Because surprisingly, very few people ask that question. You have digital banks, popping up all over the place, and even within digital banks, there's digital bank where there is a regulatory framework supporting it, and then there's a neobank, and all those different layers. And actually, very few people stop and ask, like, why is this needed? What is it solving? And to my mind, there's usually two, and it could of course be a combination, right? One is when you think inherently financial products that are available in whichever market you operate in are broken, which means there needs to be a very fundamental redesign. The other approach is, core financial products are not broken, but the way they're consumed, how easy they are to access, how easy it is to get onboarded, how easy really the communication around is, right? Is that what you're solving? And that's why it's easy. I think it's very easy the moment you see a digital bank's, app or website. It's very easy to understand what problem they were trying to solve. And of course, best of both worlds would be theoretically, the ideal outcome. So if I look at it in that sense, I definitely think the latter, right, wherein the consumption of financial products and services, the communication around them, the amount of friction there is today, that definitely needs to be addressed. And so if that's what digital banks are looking to solve, then 100%. Do we fundamentally need a redesign of financial products themselves? Yes, it applies more to, it definitely applies to credit. Sometimes I think it even applies a lot to investment products and so on and so forth. Payments is, I think, something that is a common thread across all of these. And unsurprisingly, payments is what has, evolved the most, to the point that now you have 10 different and good options to do the same thing. So maybe the next thing you ought to be solving for is, instead of me figuring out which of these 10 is the best route for me to go, my digital bank should figure that out for me. So yes, much needed, but probably with a bit more focus on what you're actually trying to solve.
Great. Irina?
Well, first of all, I absolutely agree with Aditi. I'm a big supporter. I'm convinced that digital banks are a necessity, and they open opportunities for innovation. They create value. So even if you read some of the the documents and policies that are being published by on digital banking or neobanking, challenger banking by the regulators around the world, be it MAS, be it the Bank of England, a few years ago, I think the main premise of all of those policies is actually about encouraging innovation and sort of controlled liberalization of the banking world and the banking market, while simultaneously protecting the customers, all the citizens in that country. So, and there's two very specific ways, and I guess I will probably just be rephrasing what Aditi said. It's about additional incremental economic impacts in bringing access to the services to some of the segments or cohorts of people that didn't have access to them before, which is about growing the pie, but it's also about improving the quality of that pie, improving the quality of the customer experience. That's why I'm actually quite excited about it. It is about growing the size of the pie as opposed to creating competition.
Payal, your view on it?
Yeah, so absolutely echoing the points that have just been raised. I think it would be remiss of us not to mention the impact that the pandemic has had in terms of further accelerating the need and interest in digital banking. So this idea of people being able to have access to financial services and do so in a way that is quick and remote. For me, what remains quite interesting and something that I'm always keen to look at and discuss is how these digital banks and offerings are really differentiating themselves and really doing so in a way that makes sense to consumers. I see a lot of the same language and terminology used, and I think it's important from a consumer perspective for them to really understand sort of what is this offering, how is it different from other players in the space.
Thank you. Grace?
Sure. So I think I would echo there, because I think when it comes to building innovation, I think you would consider that a very small percentage of consumers would choose something like a digital bank for their personal financial management tool. But that is precisely what Christensen's Innovators Dilemma is all about, when you're able to capture a small segment of the market with a different value proposition and grow from there. And I think what we have seen is that there is a whole new potential in terms of the different kind of products you can build, from ESG products to a new way of offering payment solutions. And this is also transferring value back to your traditional banking propositions on how you deliver banking services, because I think it offers you a platform to test whether some of these delivery models actually work in a totally different type of platform as well. So it's both an experiment for traditional banking players as well as a new way of delivering payment services for incumbents as well.
Great. So the next question is again for everyone. So let's debate and clear the mist over the fact that between banks and fintechs might be a regulatory bias, or better is the question, is there a regulatory bias? Are the regulatory standards playing field different for fintech and traditional FIs? Payal?
So I definitely see it as a bit of a myth. I worked on both sides. So I worked in banking for quite some time. And I think when I was on that side of the fence, I would look at the grass as always being greener in the fintech space. And now that I work in the fintech space, I definitely see the focus and the continued focus on meeting AML and regulatory requirements. I think the key challenge around regulation is this idea that regulation needs to keep up with the pace of innovation, which is, essentially a bit of a losing battle. And as such, fintechs are very often faced with the challenge and the need to try and fit what they are doing. So this idea of a square peg into a round hole. So really trying to interpret regulations which are by and large focused on more traditional banking services and products and controls, and applying them in a space which is rapidly evolving and very dynamic. Fintechs are also hyper-focused on the consumer experience. So rather than simply apply regulations because they are mandated, there is this constant dialogue around, well, what's the essence of the risk that we're trying to address here? How can we do so in a way that doesn't impact the user experience? How can we make this process more lean, more efficient, more cost effective? And as such, there is this constant sort of dialogue and back and forth with the regulators around sort of thinking through practical application of these regulations. In a lot of ways, I feel like the fintechs are better placed in terms of meeting regulatory requirements, largely because data quality tends to be better. They are also able to leverage and use technology and automate processes far easier and quicker than banks are able to.
Great. Grace?
Sure. So I would say that most recently, I have been working with quite a lot of fintechs on the licensing experience, both for the digital banks as well as for payment services licensing in Singapore under the Payment Services Act. So I think what we have found is that there are similar challenges in building up your AML frameworks, and often you have to look at a risk-based strategy in building up your enterprise-wide risk assessment. And what you're really looking at is that in terms of effective delivering of services, UX engineering and delivery of services is essentially about designing the user interface and about understanding the user's problems, needs, and emotions, and really financial cognition and financial behavior. And you have to do so on a much deeper level, which goes beyond just ticking the checkbox on meeting the regulatory requirements. And often there are a lot wider requirements on outsourcing, on meeting different types of audit assessments, which are often quite challenging for the fintech companies. But I think quite a lot of these are equally as demanding as on the banks. And fintech companies have to realize that these should be part of their long-term strategy and not just something which comes at the back end to be handled at another level. This is something which is critical and has to go hand in hand with their business strategy as well.
Brilliant, thank you. Irina, going to your side.
Sure. So I find it very interesting that Grace, when discussing the regulatory frameworks and compliance obligations, actually touched on the consumer experience. And in fact, I'll probably do the opposite. So I think that one of the biggest innovators in the area is actually the regulator. Usually they are the ones driving the agenda and opening the floor to the new use cases, the new technologies, the rollout of things like blockchain and all the digital currency. So that's from my perspective, that's also quite admirable. But I guess in terms of comparing fintechs and banks, and obviously they're not equal. They have different advantages. One of the advantages that fintechs have, and I can definitely empathize more because I'm part of that world, is they usually have, they're a little bit faster to implement, obviously. They have the frameworks and the methodologies to do experimentation. They also are a little bit faster to collaborate and to come together, partner, create alliances with some of the other fintech operators. But at the same time, so in general, fintechs never exist in silo, and they have to rely on collaboration in principle, including collaboration with banks. And they must have this ability to work with the banking infrastructure in the most compliant way. So contrary to some of the common beliefs, fintechs actually don't compromise on their regulatory obligations. They have, they strive to be as compliant, as transparent, as diligent and trustworthy as banks or some of the larger institutions. But they need to work together. So the two pieces, in general, I think that we live in the era, in the world where competition is actually being replaced by the new paradigm, which is about collaboration. And we shouldn't be opposing the two sides, the fintechs to banks. In fact, it is about fintechs and banks working together and working together with regulators as well, and some of the other players in the area, whether it's schemes or maybe some other providers.
Great, thank you. And we're going to Aditi.
Thank you. So yeah, I think, similar to Payal, I've also spent my career either in banks or in fintechs, right? And it gives you a really interesting perspective, specifically on the question of how regulators treat both of these. I'll go back to what you said initially, right, about move fast, break things. It's understandable why a regulator wouldn't want anyone, especially a fintech, to have the break things attitude, specifically when it comes to regulation, right? You don't want to move fast and then make a bunch of people lose their money or enable, terrorist financing under the guise of breaking things quickly or failing fast. So those apprehensions are understandable because fintechs fundamentally have a different DNA when compared to banks. And again, I think it's too much to expect. If you want regulation to not lag innovation, it always will by default. Something needs to exist and have meaningful scale to need to be regulated, right? And so by the time fintechs get there, chances are there's going to be a little bit of an overhang of, oh, wait, did we leave too many gray areas? And so then there'll always be that little bit of, overcompensation pulling back. And that's what you see happening, right? You see regulators coming up with regulations, getting feedback, then letting them down. And then that keeps happening. But yes, at a broad level, I completely agree. There's definitely no difference in the standards that, we as fintechs have to adhere to. Sometimes there's a major difference in perception. But if anything, and I'm basically just echoing what Payal said there, because we don't have technical debt, because the quality of data is better, because a lot of us have the luxury of being tech native, cloud native, whatever, it's almost easier for us to execute higher standards of compliance, in fact.
Great, thank you. We've been talking about challenger banks. So we've seen challenger banks come under scrutiny this year regarding their implementation of KYC when they onboard customers. Generally, regulators have given these new fintech banks an easy time. Do you think that the grace period is ending? Are the gloves off? And can challenger banks get themselves ready to deal with the full wave of AML regulations? And I'll ask Payal and Grace to give us their view on this. Payal?
Okay, sure. Look, I think challenger banks have little choice but to have processes in place that fully meet AML regulations sooner rather than later. I think the grace period that you talked about, the slight leniency that's afforded at the early stages makes sense as these companies look to really understand the use of their platform. So to really understand who are their customers, what is the risk profile of these individuals, what does onboarding and customer risk rating need to look like so that we're really targeting our highest risk clients, what does monitoring need to look like, etc. And I think it's important to have that iterative process and allow some room for that iterative process. That being said, regulators are not only interested in risks associated with individual institutions, but the financial ecosystem as a whole. So therefore, setting a level playing field, like Singapore has done as part of the Payment Services Act, where all players in this space are required to eventually meet the same standards, ensures trust and ultimately confidence in the ecosystem as a whole, which is key.
Yes. So I think with the starting of the operations of the digital banks, what it means is that you start to have more data and you start to have more customers on board. And as you are able to have more data, what it means is that you start to have more control testing results, which you are able to now work into your enterprise-wide risk assessments, and you are starting to be able to test out your frameworks and policies and be able to test out the effectiveness of practice of different types of screening tools you use in practice. So there is going to be a lot more scrutiny in the way you include such testing results in your control assessments and your structured consideration of your formalization of controls. And based on my experience, basically, I used to be from the Global Internal Investigations Group, the HSBC in Hong Kong. And I recall that, for quite a lot of these sanctions and AML investigations we were working on, when you're first starting at the initial stage of building up a framework and system without much initial data, it's usually a lot harder because you're working a lot in empty space of trying to be trying to put in the best you can. But eventually, when you have a lot more data, when you have a lot more names testing and a lot more countries data which you have in place, it's going to be a lot more configured on what kind of first line of defense or what kind of input you can have, especially from a senior management input level, from an accountability level, to test out how your two lines of defense are actually working out in practice. Yeah.
Great, thank you. So talking about payments, instant payment needs instant screening, but with cost per unit of a transaction being of utmost importance for digital banks, how can they leverage KYC and compliance technology to improve both customer onboarding experience and avert risks? Aditi?
Yes, I love talking about unit economics. That's my day job. But no, on a serious note, right? I think today, again, we have the luxury, and fintech specifically have the luxury of being in the world where there are enough and more, very, very intelligent tools and frameworks around compliance, risk, flagging, even dealing with false positives and so on and so forth. But when used right, you could build something where, really the unit ec is insignificant. Where it becomes a problem is when, I always say this, like technology used incorrectly or applied incomplete is more dangerous than not applying it at all. And you see this with a lot of banks where they're, just finding their feet with technology, semi-embraced it, and what it results in is, you're neither here nor there. And so your processes get weakened to the point where it's the false positives that typically throw your unit ec out of whack, right? Because it's not a cohesive system. It doesn't really have a uniform soul. You just try to patch too many things together. And so I think really, as with most things in the world, really the quality of execution when it comes to, any sort of technology around KYC, AML compliance is really the big game changer there, not the tools in themselves.
Right. Irina, we're going to you.
Sure. Okay. So on the unit economics, obviously, for digital banks and digital delivery, the digital onboarding, well, I guess opens opportunities for reduced costs of the onboarding, but it also has to meet certain requirements. Obviously, it's about checking it with the most updated databases. But the most important thing of the whole onboarding experience then that is becoming the new norm is that it has to leverage all of the local digital identity systems. And the other very important point is that it has to be properly localized. So if we think about, how can they do the benchmark, what do the new benchmarks look like? Apart from all of the back-end checks and everything that happens behind the scenes, people need to know that they can use whatever their most habitual way of, proving their identity is. And for example, here in Singapore, I have heard about an example of companies setting up KYCs based on the NRIC cards, but then forgetting or not realizing that NS meant that people that go into the military service, they get their NRICs taken away from them, and they're replaced with Form 11B, and that's just the type of localization that I'm talking about. I guess that is a good example of how you could sort of not knowingly, not exclude certain segments of the people. So I think it's very important to make sure that you pay attention to localizing the experience, to collaborating with, again, the right partners, the partners that are proven in the space, that have the right capabilities, that have the right systems in place. But I do think that digital banks will really help us to set and see the new benchmarks and see the bar being set quite high for the real, true, seamless KYC experience.
Brilliant. And last but not least, Grace.
Yeah, so I know quite a lot of the discussions in this space often focus on retail KYC, but I'll provide a little insight on corporate KYC because I think there are very interesting challenges there. So I've looked into this area in great detail because I was involved in a project actually with ASIFMA to prepare best practices for AML KYC for corporates in particular. And I think there is very, very much great variation across different jurisdictions in terms of regulatory requirements and the kind of documents you can obtain as well. And in terms of what is expected for regulated institutions versus private companies, and in terms of your tier 1 countries versus tier 4 countries, FATF gray list and all that, the whole variation for SMEs do vary. And I think what is important there is that you can really make things a lot more seamless by building up your global data transfer policies, your framework, and having a very good customer data risk management system on how you track data, on how you store and track the retention and transfer of data, and understanding very well what you can transfer in terms of banking secrecy requirements as across the jurisdictions. Because the worst thing that can happen is that you make a decision to offboard a particular client in Hong Kong for AML breaches, and you're onboarding that same client in UK, for instance. That would be a terrible decision from an onboarding perspective. So there are lots of interesting issues, both from a credit risk perspective as well as from an AML KYC perspective in the corporate space. And those are also key things to watch in this area. Yeah.
Great, thank you. So we've been talking about obviously open banking from the beginning. Open banking is really taking hold in Europe. I saw a stat that we have now about 2 million people in the UK using open banking services. Do you think this hyper level of growth will be seen in other markets too, like Singapore and the rest of the Asia? Is there going to be a sudden rush of people wanting to share their financial data with service providers? Payal, I'm addressing this question to you.
So digital technology is driving financial services away from the traditional model of housing everything in a bank. So traditionally, the bank is where the consumer absolutely should have gone to resolve their needs, from loans to mortgages to accessing insurance, brokerage, and investment products. And so this monolithic relationship was that banks were trusted with safekeeping customers' sensitive and private information primarily. The relationship, though, now is breaking down as technology makes it seamless for customer data to move with the customer's consent to merchants, fintech companies, e-commerce platforms, anywhere the customer wishes it to go in order to receive a desired service. So this new world of open banking is transforming financial services away from pure proprietary models to the creation of ecosystems in the form of partnerships with all manner of non-banking institutions. So in theory, open banking is a win-win. So customers get exposure to better, cheaper, and more convenient services via a merchant or sales platform. Those partners get to do new businesses, and banks, by sharing their data, create new channels through which they can acquire new customers and develop opportunities for cross-selling or upselling existing products. The term open banking, however, assumes some level of regulatory mandate or support. So the best known framework that I think is globally recognized is that in the EU, which requires banks to provide customer data to third-party providers via open APIs. Governments in Asia have adopted a different stance. So in Australia, for example, Parliament passed a consumer data protection law that is broader than just open banking, but resembles the UK system in practice. The HKMA issued mandates closer to the European requirement, but with important differences in standards and liabilities. Singapore and other Southeast Asia countries, on the other hand, have taken a more laissez-faire approach. To your question about people's appetite in terms of sharing data, I really think that varies depending on where you are in the world. So what I'm very aware of is that here in Singapore, people seem to be very comfortable sharing their data. We share a lot of our data regularly. That differs, I think, in different regions. I also think a key part of this is how comfortable and confident individuals are that their data that they are sharing is then being used in a transparent and regulated way and for legitimate and the intended purpose for which they shared that data. So I think having that framework in place to support that ecosystem is key, and what will allow it to be an area that continues to grow.
That's great, thank you. And I think picking up from your point on APIs, so the rise of APIs for faster payments, how have you improved straight-through processing at your organization, and what are the stumbling blocks companies face when integrating APIs into their own ecosystems? So I'm asking the question to Aditi and Irina.
I think, so the challenges are actually two-way, right? And here again, the difference between, I suppose, institutional fintech versus consumer fintech, or rather when you're specifically dealing with, corporates and banks and SMEs, that really comes into play. I think a lot of the times, the challenges within straight-through processing aren't so much with the fintech consuming APIs, but with whoever you're catering to consuming your APIs, right? I could build the most beautiful, effortless STP product in the world, and yet when, let's say, I offer it to a corporate or a financial institution or anyone who's then extending it to their customers, and they have a batch processing system, that's it. That's where my STP ends, right? So that's one massive challenge that we face, because I think there's a lot of elegance that isolated systems can develop within themselves, right? It's only when you're moving from like one framework to another or one organization to another that the ball really gets dropped. And I think solving for that is actually like genuinely challenging, because it's almost like saying everyone should upgrade to the latest standard at exactly the same time for everything to be STP, which is obviously a lot easier said than done.
Irina?
Sure. Sorry, I've been exposed to some of the API-related implementations in some of my past companies, and as well as currently at Rapid. So in the past, what I have seen is that one of the biggest challenges is that there's anything that has to do with API integration. If you want to integrate a third-party API, is related to the kind of like the challenge of the necessity to allocate the very precious engineering resources for that implementation. So in some cases, it takes a few months, and it takes away from some of the new feature being built. So, and from that perspective, I think that brings me to the next point, which is about the fact that there is the world of the APIs is currently quite fragmented. And there's quite a lot of like a notion of all the different API frameworks and technologies. So we do live in the world of cloud these days. And I think normalizing based on the current experience at Rapid, and where API is really at the core of what we do, normalizing those APIs is one of the other big challenges that I'm seeing. And that's the difficulty that we are trying to solve also for our customers. So that is actually, in fact, our main value proposition, taking all of these fragmented APIs, the third party, like the local payment methods, and trying to normalize and bridge them together into so that's why we're called FinTech as a Service. We're trying to create the single payment method under one umbrella to make sure that the innovation is probably more efficient. So that's, I think that's what enables the faster payments, more frictionless experience, and the ability for some of the companies that we work with to do, I guess, to accelerate their both in time to market to develop new solutions. And save resources on the engineering resources to really invest them into the products as opposed to the third-party implementation.
Right, thank you. Switching a bit the gear, so we're seeing a real proliferation in the number of payment rails around the world, and each one has its own advantages. How do corporate begin to navigate this increasing complexity to always use the rails and that suit them for any given payment? Is payment orchestration the answer or something else? Aditi?
In fact, it's funny, right? Because payment orchestration, I think it's the oldest trick in the book, right? Like the first, if you look at any country's most basic payment system, it's typically some combination of a real-time and a non-real-time method of settlement. And then everything else that you create on top of that technically is an orchestration layer. Now, what happens over time is that even these orchestration layers become, too difficult to onerous to consume. And so, a few years back, everyone used to say middleware. Now everyone says platform, as a service, all of these buzzwords. And, like I said, it's a good problem to have. If today you have 3 ways of doing the same thing, right? Each with its own trade-off, maybe, but if you have 10 or 12, that again becomes cognitive load. And very often payments are incidental to your business, right? Few organizations, and we all happen to be in those, where that's our bread and butter. But for a lot of other businesses, payments is just something that enables your core business. And so in that sense, you need someone else to, exactly how you put it, orchestrate it for you, right? Just tell you, look, this is the short order menu. These 3 things make sense for you. Pick one and just go with it. So resounding yes on that question.
Brilliant. Going to you, Payal?
Yeah, so echoing Aditi's point, to be honest. I mean, I am definitely supportive. I think one of the key sort of pieces is finding the right partner, finding those partnerships that can work for you. That and one of the key pieces that I work with clients on, especially those that are at the early stages of considering applying for a license or won't be applying for a license at any point, is really thinking about sort of this idea of relying on controls when you partner with your various payment rails. So, what controls do you need to build out yourself? What controls do your partnerships have that you can rely on? To what extent can you rely on those controls? And really having sort of a granular understanding around that, I think, is also key.
Irina?
Sure. So the way I see the global payment trends and how basically they evolve is maybe 3 levels or 3 different things happening. So on the consumer level, something that is driving the complexity is just the increased number of the different local payment methods that are being developed. Sometimes they're also driven by the second level, which is the country's initiatives like real-time payment networks that partially solve the fragmentation. They sometimes bring together, for example, they serve as a connecting tissue between the consumers' PayNow is one example, UPI is another example. So they bridge together consumers, merchants, and banks, and some of the other operators, the wallets that we have in the countries. And then there is also this enterprise level when there's also some sort of an increased platformization when companies are trying to absorb it all and bring into the sort of the level of the payment orchestration or the APIs. And I think the answer to this complexity is indeed in this open API sort of the cloud mentality. And yes, it's very important to select the right partner. But in reality, I think there's a few really good initiatives that are already taking place in terms of, even banking, for example, some good examples of the banks opening themselves and making themselves more partnerable, combining their solutions into the OPI. So CT or DBS, for example, here in Singapore have created libraries, and I want to say hundreds of APIs, at least in the case of DBS. That is something that I've seen that they're exposing, and they're opening them up to the other third-party partners. I think Standard Chartered, maybe not on the API, I don't know on the API level, but I know the Standard Chartered has a really large team looking at the fintech alliances and possibly building this orchestration as part of their strategy, as part of their internal innovation, but also connecting the pieces together. So I guess, yes, probably there's no simple answer to the question on how to solve the complexity. And payment orchestration could be one of it, and everyone will probably have to come up with their own approach. But I think it is, again, all about the collaboration and the fintech working with all the other ecosystem players, bridging, finding solutions. There is a lot of positive movement in that space, and I'm quite excited about what the future holds for us.
Great, thank you. I think we've got time for one more question. So we've talked about fintech a bit, but actually several large traditional banks this year have been under investigation for AML issues regarding very large sums of money. Is it just a case of AML is difficult in a time when money is instantly moved from account to account around the world? What types of technologies are emerging to help solve these AML issues, Grace?
Sure. So I think most recently I was just reading about the flow of funds for one of the recent exchange hacks of KuCoin, which is quite interesting. So I follow digital assets hacks quite a bit because there are a range of white hat hacker flows like Elliptic as well as other models which follow the trace of funds. So crypto exchanges would be able to freeze the funds and pick them up. And I think there are quite a lot of different types of technologies which are now able to trace and pick this up. And I think gradually banks as well as different types of fintech companies have to be more plugged into the space as well, and have to understand that they do have to be plugged into industry groups. They have to be plugged into the latest technologies in order to ensure that they adequately are able to pick up the trends and to be able to meet the regulatory requirements and to be able to meet relevant information reporting requirements. And especially in the field of digital assets, some of you might be familiar with what is described as the travel rule requirement. And this has been particularly challenging. And in fact, there's one concept in this industry which is called the sunset requirement, because depending on whether the particular jurisdiction has put into place regulatory requirements to adhere with the travel rule, then there might be gaps between different countries on whether you are able to pick up the AML breaches. And what you have there is that you have to make sure the partners you're working with in the space, you have to make sure that your technology is up to scratch to be able to pick up all these trends. And so I would say in response to your answer that it's not an easy task, even for traditional fiat currencies. That continues to be a tremendous challenge in this industry. Yeah.
Brilliant. Thank you. Thank you ever so much. We have now come towards the end of our panel conversation. It was really, really great to have everyone. Irina, Payal, Grace, Aditi, it's been a really pleasure to talk to you today. And thank you for discussing with us the frictionless payments. And thank you to our audiences as well.
It was a pleasure. Thank you so much, Irina.
Thanks so much.
A huge thank you to our esteemed panel of speakers for an informative discussion into how we can be faster and more compliant in the race towards digital banking excellence. Up next, we are diving into why digital banks win with analytics-driven decisions. Presented by gold sponsor FICO, this presentation will explore how analytics can be used to make better decisions. This session will begin shortly at 3:45 p.m. Now don't forget to click the next session button located at the bottom of this page for the next agenda, and I will see you very soon.